This video will cover PE and other price ratios. We'll compare and contrast leading versus lagging PEs. We'll derive the leading PE from fundamentals. We'll discuss using PEs to sort stocks in the value versus growth categories. And then we'll derive other price ratios such as the price to sales and price to book value ratios. The price earnings ratio is probably the most commonly used ratio in investment management. It's easy to use and it's very easy to calculate. It measures the price divided by earnings per share on an annual basis. So this is earnings per share on an annual basis. This is measured in dollars. This is measured in dollars. So basically the dollar signs cancel out and it's just a multiple. So sometimes you'll see just an X, meaning multiple, because it's how many multiple times price is over earnings. Now we can't get very far with this particular version of it because I haven't given you any timing subscripts, timing components. There's two types of PE ratios. There's a lagging PE, and the lagging PE takes today's price times 0 divided by earnings that just happened right at time 0. So basically your timeline is this. Here's today times 0. You're looking at a stock price right at this point in time, and you're looking at the earnings that came out just beforehand, right there for this whole period. So that's what's called a lagging PE. What's lagging is the earnings. And this is probably the most objective and the most commonly used PE ratio out there, because price, obviously, you can get that right off the web. And then earnings are relatively objective, meaning that most analysts can agree on what the earnings per share were last year. I say most, but some of them can't, because often earnings per share have extraordinary items in there and discontinued operations, which need to be backed out if you want to look at a clean price earnings ratio. Now, this is objective, but it's not the best from a logical and theoretical perspective, because it's using lagged earnings, and you know stock prices are forward-looking. So the price here is forward-looking. It's based on future earnings that the company will have, but you're looking at past earnings. You're scaling it by past earnings. But by far, this is the most common PE ratio out there because it's easy to get your hands on that, and most people will agree on what earnings are. Now there's another form of PE called a leading PE, and the leading PE is today's price divided by earnings for the next period. So some people like to put a little hat there because it's earnings that are expected. It's the earnings that would cover this period, this particular year, in which case the price is forward-looking and so are the earnings. So this is theoretically more justified, but the problem with this is everybody's going to have a different estimate of what earnings per share will be for a particular company. So your leading PE is subject to an estimate of earnings, whereas this lagging PE, most people can agree what the earnings were in the past. So now normally you see that leading PEs are usually smaller than lagging PEs. And you might want to think, well, why would that be? Well, here's the issue. You have a price today divided by earnings in the past. How do you get that to equal PE1? I'll skip the little hat there for now. How do we get there? Well, it's this. Need to multiply this by 1 plus G. So when you have positive growth, this earnings per share next period will be higher, and that means your leading PE will be smaller than if you just simply looked at lagging PE. So let me give you an example. According to the Wall Street Journal, the lagging PE on the S&P 500 is 20, and its leading PE is 17. What is the implied growth rate in earnings per share for the S&P over the next year? Okay, well, we can just plug the numbers in. It's saying lagging PE is 20. That means this number right here is going to be 20. And then it's 1 plus G. I'll just carry this part over. And then that's going to equal a leading PE, which is 17. And if we solve for this, then we have an implied growth rate in earnings per share of 17.6%. So PE ratios are not only useful, they're fundamentally useful in the sense that we can derive them from fundamental values. So it's not like we're just grabbing a ratio and taking a ratio and calculating price to earnings. There's actually a fundamental, it's actually supported by fundamentals. And here's how. So remember, we used the constant dividend discount model where we had dividends and we had constant growth. And we said, look, this is a theoretically correct model, assuming that G is less than K. It's theoretically correct because it discounts all the cash flows at the right discount rate and reflects growth. And so what we can do is we can translate this into, your dividends next year are equal to your payout ratio times your earnings next year. So just substitute that in. And then divide both sides by E1. If you divide both sides by E1, we get the PE ratio, a leading PE ratio equals to the payout ratio, which is a fundamental variable set by the board of directors that determines dividends, divided by K minus G, the discount rate and growth. And so there, very, very simple link that says, look, the PE ratio is more than just dividing two numbers out. It actually has fundamental justification. Now, what's also really interesting about the PE ratio is that the PE ratio is, out of all the valuation models that we've looked at, the simplest. So we're looking at a ratio, and now I'm talking about valuation. Wait a second. So look, I just showed you the constant dividend discount model as a way to estimate price. And we looked at free cash flow in another video. We looked at the residual income model. Now we're looking at this model to help determine valuation. So we're not looking to determine the price per se, we're looking at the price ratio and asking ourselves, is the price ratio high or low? It turns out that the price ratio is high relative to annual earnings. The stock is expensive. That stock is expensive. So why might the price of the stock be high relative to earnings? Well, it's because you can always draw the timeline out. The price is looking way beyond next year's earnings. This is only going out 1 year. And this stock is looking way beyond there because it goes out to infinity. And so what you see is when you have high PEs, and I'll use that leading PE, it implies that there's a high growth built into it. Because if you have high growth, remember that negative sign? When it's on the bottom, when this is high, that means your PE ratio is going to be high, all else being equal. So that when you see high PE ratios, it's telling you it's probably a growth stock. Now, what happens if you see something with a low PE? So you got a PE here, and this whole PE ratio is low. That's because earnings are high relative to the price today. And so what people look at this is, they look at this as a value stock. They call this value because people believe that the stock is cheap. It means that the price relative to earnings is low. So it must mean a discounted or cheap bargain stock. So therefore, you can use PE ratios to sort growth versus value stocks, which is probably one of the most common dimensions of sorting stocks for investing. Growth investing versus value investing. The other thing you need to keep in mind when you look at this value and growth, it's all in the eyes of the beholder. So you may see a high PE ratio and signal it to represent growth, but it could actually be representing a low K. So don't forget K is in there. And so when you see high value stocks, so when you see stocks that are you consider to be value stocks because they have low PEs and the price is low relative to the earnings. That's another way to look at it. The price is low relative to earnings. That could be because K is really high, that discount rate, and the stock is really risky. So one of the problems is that when you buy value stocks, you could be loading up on highly risky stocks. That's why they're so cheap. So always keep that in the back of your mind. And if you remember this formula, you can always see that the price earnings ratio is always a function of K as a function of G. Now what we want to do is let's look at some other common ratios. And a really common ratio is price to sales per share. Okay, price of the stock to sales per share. And how do you get there? So how do you get there from a PE ratio? Well, let's look. We can actually use the PE ratio method to get at this ratio here. So we just said that price is equal to this, which equals payout times earnings divided by K minus G. And what we can do is let's try to translate earnings per share and translate it as a function of sales per share. And we can do that. So we take sales per share times net profit margin, we'll get earnings per share. So how do we know that? Well, you got sales divided by number of shares outstanding times net income divided by sales. The sales cancel and you get net income to shares. Well, net income divided by shares is earnings per share. Therefore, we can boil this down to say, look, payout times sales per share times net profit margin over K minus G. Okay, so we're assuming constant growth for simplicity purposes here. We don't have to assume constant growth forever. These concepts would apply even without assuming constant growth if you have variable growth. So now let's divide both sides by sales per share. And we should be clear here, this is sales per share period 1, net profit margin period 1, so it matches up with earnings per share period 1. So then it's sales per share period 1 equals the payout ratio for the dividend times the net profit margin divided by K minus G. And there you have it, a fundamental ratio for price to sales. In other words, people have a really good reason for looking at price to sales ratios to try to determine whether or not a stock is over or undervalued. Now, let's do price to book. And we just call it price to book. It's really price to book value per share. And so we start out with the same model. Now let's get this as a function of book value. So it turns out that if you take book value per share and multiply it by return on equity, you get earnings per share. Now how do we know that? Well, book value per share is equity divided by number of shares times net income divided by equity. So equity crosses out, it's net income divided by shares, that's earnings per share. And there you have it. It's payout times book value per share times return on equity divided by K minus G. Okay, that is a function, that is an estimate of price. Divide both sides by book value per share. Most people just call it BV, and it's assumed that it's on a per share basis because the stock price is always on a per share basis. So we just write it out here. And again, we have price to book relative to fundamentals of the company. In this case, the fundamentals of the company specifically here are return on equity, besides the K and the G that we normally see. So the way to interpret these ratios is whenever you have a high ratio, it signals that the stock may be overpriced, or it could be have a lot of growth built into it. And when the ratios are low, it means the price is low relative to the denominator, which in this case is book value, and that means it could be a cheap stock at that point. There's one other ratio that I want to look at, and that's called the PEG ratio. So the PEG ratio is the price earnings ratio, and I won't bother to differentiate whether it's leading or lagging, divided by G, little g. And that's one way to scale the PE ratio for growth. So remember, I told you the PE ratio has growth built into it. Then this is a way to scale out growth so you can compare one stock to the next, because stocks are going to have very different PE ratios because they have very different growth rates. So we've been talking about the PE ratio for most of this video. Now I have a question for you. What is a high PE ratio? What's a low PE ratio? What's an average PE ratio? So we've been talking about PE ratios through most of this video. Now I have a question for you. What would you consider to be a high PE ratio? What would you consider to be a low PE ratio? What's the average? How would you calculate an average? And what does the patterns look like over time? Well, that's not hard to answer. What I suggest you do is you go to Google, type in S&P 500 PE ratio over time. Pull up a chart. Here's one, for example. I got this chart. It goes all the way back into the 1800s. And what you see is relatively stable PE ratios all the way up until around the years 2000. And that peak around 2000 was the dot-com bubble. And the dot-com bubble, internet stocks started to take off and people had really high expectations for growth. And so growth, the G, was really high, which meant that the PE ratio was very high. And then you see that second spike in 2010, you see that spike. That's the Great Recession. Maybe it's 2009. That is the Great Recession. Stock prices fell dramatically in that time period. But you know what also fell? Earnings fell. Earnings fell to a really low amount. Annualized earnings per share were really small, close to zero. When you have a denominator that's close to zero and a price that's reasonable, you're going to have a really high skyrocketed PE ratio. And that's what happened. It went off the charts here. It's over 65. It's way higher than that. That's because basically we had almost zero earnings. And then, when the S&P started earning, so when the S&P started generating earnings, the PE ratio came back to normal. So why the S&P 500? Well, remember, the S&P 500 is a market index. It represents the average stock. So if the market goes up, the S&P goes up 1%, then that means, the average stock went up about 1%, and the S&P drops 1%, the average stock fell about 1%. So the S&P 500 is a good indicator of the average stock. And so what has the average stock done since the 1800s in terms of PE? Let's see if I can draw it. It's done something like that. So from about the 1800s to about 1980, we see an average PE of maybe close to 13, 14 or so on average. It's high in some periods and low in others as we go through the business cycle. And so that's a good benchmark for that period. Now look what's happened since 1980. Look at this upward trend. Significant upward trend. Now, what do you think that's about? Well, let's dig back into the fundamentals that drive PE ratios. It's either K or it's G. Now, G could have gone up on average. No doubt about that. The G could have increased for the S&P 500. That's part of it. But what about K? Well, let's take a look at K. K has the risk-free rate built into it. Remember, we talked about it in the dividend discount model. We even looked at it in the residual income model and the free cash flow model. The security market line from the capital asset pricing model is K equals the risk-free rate plus beta times the market risk premium. And so built into K is interest rates, the risk-free rate. And so here we have the interest rate for the T-bill. Going back into the 1940s here it looks to be. And so what do we see since 1980? We see a strong downward trend in interest rates over time. And so there you have it. I mean, part of that upward trend we're seeing here is caused by lower interest rates, a lower K, a lower discount rate. And then some of it's probably due to higher growth expectations. So there you have it. bench your individual stocks against the S&P 500 in terms of a PE ratio, and that'll help indicate when stocks are good buys and when they're not. That'll indicate a stock that has a high PE ratio versus a low PE ratio.